All right, get ready because we're diving into some seriously cool stuff today,
Yeah.
like trading, but with, a bit of a twist.
Egg twist.
Yeah. We're talking about using the Fibonacci sequence, you know, to
Yeah.
step up your trading game.
Oh, okay. I see where you're going with this.
Yeah, those spirals and seashells and all that. Turns out it's got some pretty surprising uses in the financial markets, too. Who'd have thought, right?
You're right about that. It's amazing how that pattern from nature, it just pops up in the most unexpected places. Almost eerie how it plays out with price movements.
Eerie is a good word for it.
Okay.
And you're specifically interested in using what are called Fibonacci retracements and expansions to, really pinpoint your entries and exits for your trades.
Exactly. Those are the ones.
Yeah, and maybe even work with FTMO.
FTMO. Yeah, they're a great resource.
For sure. For all our listeners out there, if you don't know FTMO, definitely check them out. But back to this whole Fibonacci thing. This isn't exactly like beginner stuff.
Yeah, you're right. It's definitely more of an advanced technique, but it can be really powerful,
Yeah.
for zeroing in on those sweet entry points and even maybe squeezing out some more profits. But, and this is a big but, you absolutely have to have a solid understanding of risk management. It's crucial.
I was hoping you'd say that. Risk management is key no matter what strategy you're using.
Couldn't agree more.
But before we get ahead of ourselves, let's back up a bit. Can you walk us through the basics of how Fibonacci actually works in trading? Especially since you're interested in using it to scale in, like adding to your position, even when the market seems to be going against you.
Okay, so let's break it down. Fibonacci retracement levels, they're basically specific percentages like 23.6%, 38.2%, and so on.
Okay.
Traders use these levels to pinpoint areas on a chart, potential areas where the price might pause or reverse. We call these areas support and resistance zones.
Hold on. Support and resistance. For those of us who are maybe just getting started with trading, can you explain what those are?
Of course. Just picture support like a floor and resistance like a ceiling, but for prices.
Okay.
Support is basically a price level where there's enough buying pressure that it might actually stop a downtrend. Resistance is the opposite. It's where selling pressure might kick in and cap an uptrend.
Got it.
Does that make sense?
Yeah, so these Fibonacci levels are kind of telling us where those floors and ceilings might be. That's wild.
Exactly. Now, during a price correction, like a little dip in an otherwise upward trend, these Fibonacci levels, they can almost act like magnets.
Magnets.
Yeah, pulling the price back toward them.
Oh.
That's where scaling in comes into play. You had a good example, that GBPJPY long trade, the British pound against the Japanese yen, to kind of illustrate this.
Wait, before we get there, can you just quickly explain what a long position is? For anyone who's new to all this.
Sure thing. When you open a long position, you're basically betting that the price of an asset, whatever it is going to go up.
Okay.
So you buy it with the hope of selling it later at a higher price, making a profit.
Got it.
Makes sense.
Yeah, that makes sense. So back to GBPJPY. Let's say you open a long position because you believe the price is going to rise. But the market, it takes a little detour before heading in that direction.
Right, exactly. Instead of panicking, you would keep a close eye on those Fibonacci retracement levels. If the price drops to, let's say, the 23.6% retracement level, and you're still confident in your initial analysis.
This is where it gets interesting. You're saying you might actually buy more at that point.
Exactly, and if it drops even further, maybe to that 38.2% level, you might buy even more. Always keeping in mind your risk management strategy, of course.
Right.
The idea is to bring down your average entry price. Think of it like snagging a discount on a stock that you believe in.
So if the market does eventually turn back in your favor, like you thought it would, that lower average entry price could mean a much bigger profit, even though you bought more when price was, dropping.
Exactly. But, and I can't stress this enough, it's not about chasing your losses or just throwing money at a losing trade, This strategy requires a very clear understanding of your risk tolerance, careful position sizing, and always setting a stop loss.
Okay, so risk management, clearly a big deal here. We're on the same page. Tell me more about how that plays out with this strategy. What does it actually look like in practice?
It really comes down to having a plan, and actually sticking to it. Before you even think about entering a trade, you need to know how much you are personally okay with potentially losing.
So that's like my risk tolerance.
Exactly. And your position size, meaning how much you're actually putting into a single trade, that should always reflect your tolerance.
Right.
You never, ever want to risk more than you can afford to lose.
Makes sense. Makes sense.
Right.
Yeah. What about that stop loss you mentioned? That sounds like a pretty important Safety net, especially with a strategy like this.
It's absolutely crucial. A stop loss order basically automatically closes your trade if the price moves against you by a certain amount.
Okay. It's like an emergency brake that limits your potential losses.
Got it, got it. So we've covered how to potentially enter trades using Fibonacci retracements, and of course a whole lot of risk management. But what about knowing when to, call it a day and actually lock in some profits? I imagine that's where those Fibonacci expansions come in.
You got it. While retracements help us kind of gauge how far a price might pull back, expansions help us project where that price might run to after that correction is over.
So if retracements are like looking in the rearview mirror, expansions are like looking ahead at the road.
Exactly. We're still using those same Fibonacci ratios, but this time we're projecting them forward instead of backward.
Okay.
Some common expansion levels to watch out for are 100%, 127.2%, 161.8%, even 261.8%.
Wow, okay, so going back to our GBP-JPY example, how might those expansion levels guide a trader's profit-taking strategy?
Okay, so let's say our trader, they bought GBP-JPY at 1.250.
All right.
Using Fibonacci expansions, they could calculate potential price targets, right?
Maybe the 127.2% expansion level, that comes in at 1.260. They could set a sell order at that level and boom, they lock in a profit if the price hits their target.
So they're essentially using these expansions as potential exit points. That's pretty slick. But are these Fibonacci levels, whether we're talking about entering or exiting, are they foolproof? I mean, is it really that simple?
I wish it were that easy. Unfortunately, trading is never that straightforward. Fibonacci levels are really more like guideposts than like hard and fast rules.
Meaning the price doesn't have to respect those levels. It could just blow right through them.
Exactly. Remember those support and resistance levels we were talking about? Fibonacci levels can definitely help us identify potential support and resistance zones, but they're not guarantees.
So if I can't just solely rely on Fibonacci, what else should I be looking at?
Think of it this way. Fibonacci gives you a framework, but you have to confirm your decisions with other tools as well.
Okay.
This is where technical indicators can be super helpful.
You're talking about the RSI, the Man CD, things like that.
Exactly. Indicators like those can give you a much better sense of the momentum, the trend strength, even potential overbought or oversold conditions.
So let's say the price is approaching a Fibonacci expansion level, but then an indicator like the RSI, it's flashing a warning sign. That could be a clue that maybe it's not the best time to exit the trade just yet.
You got it. Or imagine the price is getting close to a Fibonacci retracement level and you're thinking about scaling in, right? If something like the MCD is showing strengthening momentum, that might give you more confidence to actually add to your position.
It's like having multiple pieces of evidence that all kind of point in the same direction.
Right.
It gives you more conviction in your trading decision.
Exactly.
What else can traders use alongside Fibonacci to make those smarter decisions?
And hey, don't forget about the psychological levels. We touched on them earlier.
Oh, right.
Those round numbers, let's say 1.300 on a currency pair.
Yeah.
Those often act like magnets for traders, because they just feel significant.
So psychology plays a role too. It's not just about the numbers themselves. It's about how we, as traders perceive those numbers.
Exactly. And never underestimate those previous highs and lows. They can be really interesting. They can act like almost like ghosts in the machine, haunting those price levels and potentially influencing where the price might reverse.
It's almost like the market has a memory. Those past highs and lows can actually give us clues about where it might kind of turn around again. So it's like this Fibonacci levels. They give you that broad framework, for spotting those potential entry and exit points, but then you got to fine tune those decisions by looking at those technical indicators, those psychological levels, even that historical price action. You're like a detective piecing together all these clues to solve the mystery of the market.
There you go. It's not about relying on just one tool, but actually using a whole combination of strategies to make those more informed decisions.
Okay, I'm really starting to see the bigger picture here. Fibonacci isn't about predicting the future. It's more about understanding those potential rhythms and patterns of the market.
Exactly.
Just like you said earlier, those patterns from nature showing up in those price charts. But before we wrap up this deep dive, let's kind of bring it back to those main takeaways, especially for our listeners who are maybe just starting to explore this whole Fibonacci thing.
Yeah, the biggest takeaway, and I really can't stress this enough, Fibonacci can be an incredibly powerful tool.
For sure.
But it's not some magical get-rich-quick scheme.
Right.
It takes some work to understand those concepts, and it takes discipline to actually stick to your trading plan.
And of course, we can't forget our favorite topic, risk management. No matter how confident you are in a trade, you always have to manage your risk.
Absolutely. Define that risk tolerance, size your positions appropriately, and always, always use that stop loss order. Those are like the golden rules of trading, regardless of the strategy you're using.
Risk management. The key to staying in the game for the long haul. It's not just about making those big wins, but it's also about protecting yourself from those big losses as well.
Couldn't agree more.
So for our listeners who are intrigued by what they've heard today and want to kind of explore this further, what's your advice? Where should they go from here?
I always encourage everyone to, just keep learning and keep experimenting. See how Fibonacci might work with other strategies that you're already using, back test your ideas, see how they would have performed in the past.
Right.
And just remember, trading, it's a journey, it's not a sprint. It's all about constantly learning, adapting, and just finding what works best for you.
That's great advice. Trading isn't about getting it perfect right away. It's about constantly improving, trying new things, and maybe even, having a little fun along the way.
Exactly.
Who knew that a sequence found in nature could unlock so many possibilities in, the world of trading? And with that, we're going to wrap up this deep dive into Fibonacci. Thanks for joining us, and happy trading, everyone. Thank you for watching. Don't forget to check out the description below for more content related to today's episode. You can listen to our podcasts on various platforms. Plus, we have an exclusive offer for you. Use our discount code to get 10% FA off and potentially save up to $120 on your first purchase at FTMO. If you enjoyed this video, please like, subscribe, and share your thoughts in the comments below. Happy trading!